Imagine the wildest party in human history. The champagne is flowing, the jazz is loud, and everyone is throwing $100 bills out the window. It's 1922, and the vibe is immaculate. World War I is over, and America has emerged as a global victor, entering a period of unprecedented economic prosperity and cultural change known as the Roaring Twenties. This wasn't just a party for the elite, it was a technological revolution. Factories that once pumped out machine guns for the war are now churning out toaster ovens, radios, and Model T Fords. Henry Ford has turned manufacturing into a religion. Thanks to his moving assembly line, a car that used to take 12 hours to build now rolls off the line every 90 minutes. By 1927, the 15 millionth Model T has hit the road, and soon everyone gets a car. This era marked the official birth of consumerism. New inventions like the vacuum cleaner and electric washing machine have become hot commodities. By 1929, 10 million American homes have radios, allowing them to hear advertisements for even more gadgets in glorious AM fuzz. The country's wealth has more than doubled, and many genuinely believe the good times will last forever. But here's the catch. Nobody actually has any money. They have credit. This decade was the birthplace of the buy now, pay later culture. You want a washing machine? Put it on a tab. A fur coat? Finance it. Banks are giving out loans to everyone, and by 1925, approximately 75% of household goods are purchased with borrowed money. Americans have discovered a new favorite hobby, investing. But they aren't just buying another laundry machine. They are looking to get more rich. The stock market has become a Disneyland for adults. For the first time, ordinary people, cooks, shoeshine boys, janitors, and taxi drivers are trading like Wall Street tycoons. Even the barber gives you stock tips while cutting your hair. Between 1921 and 1929, the US stock market increased sixfold, driven by this easy credit and a snowball effect of public enthusiasm. By 1929, investments are up 218% compared to 1922. The real magic behind this explosion was buying on margin. This was the math that effectively killed America. Here's how it worked. You want to buy $100 worth of stock, but you only have $10. No problem. You pay the $10 and borrow the other $90 from your broker. As long as the line goes up, you can sell, pay back the loan, and keep a massive profit on almost zero effort. It felt like free money. By 1929, 40% of all US consumer debt is being used specifically to purchase stocks. Banks, seeing the massive returns, decide they want in on the action too. Small, independent banks begin borrowing money directly from customer bank accounts to gamble on the stock market. Since everything is looking up, nobody notices. Stock prices have completely broken free from gravity and fundamentals. Why look at actual company profits when you can just look at vibes and the fact that the line is going up? While New York City looks like a jewelry store, rural America looks like a graveyard. The agricultural sector had expanded massively during the war, but once the fighting stopped, demand plummeted. Farmers are drowning in mortgages for shiny new tractors they can't afford, and crop prices have tanked. Because nearly 1/3 of Americans still work in agriculture, the industry's collapse is a ticking time bomb. In the cities, cracks are also forming. Industrial production is actually slowing down by the mid-1920s. Companies have overestimated their growth, and the market has reached a saturation point. People already have their cars and radios, and there is no thriving global market to sell to because Europe is still ravaged by war debt. Most importantly, working wages have not kept up with the massive profits corporations are making. This means the average person has to borrow even more just to maintain their lifestyle. A few people try to sound the alarm. Economist Roger Babson warns in 1929 that a crash is coming. Wall Street's response? They tell Roger to go touch grass, and a jazz band literally plays over him to drown out the warning. The most respected economist in America, Irving Fisher, famously declares, "Stocks have reached what looks like a permanently high plateau. It is the financial equivalent of calling the Titanic unsinkable." The music finally stops on Thursday, October 24th, 1929, Black Thursday. You look around the New York Stock Exchange as absolute chaos ensues. People are screaming into telephones, and memos are flying everywhere like delicate snowflakes, only to be trampled by businessmen running for the doors. Bankers are shouting, "All is lost, this is the end." A record 12.9 million shares are traded in a single day. You try to buy low and sell high, but the high never comes. Prices just keep plummeting. The volume of selling is so high that the ticker tape machines literally cannot keep up, running hours behind the actual trades. People are trading blind, selling stocks for pennies just to get out of a burning building. You walk out onto Wall Street with your fingers bleeding from hundreds of paper cuts earned from frantically shuffling documents. You head to a barbershop, not for a haircut, but to use the secret phone booth in the back. You dial 1933, and the back of the booth opens into a smoke-filled speakeasy. Even there, the mood is grim. Your banker friend knocks back a shot of grain alcohol and tells you, worse things could happen. He was right. After a shaky weekend, Black Tuesday hits on October 29th. It is an outright panic. Over 16.4 million shares are sold, breaking the record set just days before. In a single day, the market loses $14 billion in wealth. Adjusted for inflation, that's over $200 billion real homes, savings, and college funds gone in a flawless 10-meter dive into concrete. Now the margin trap snaps shut. Brokers begin calling in their loans. Remember that $90 I loaned you? Pay me now. But investors have nothing left. People who were rich on Monday are bankrupt by Thursday. Then the contagion hits the banks. Because banks had been gambling with customer deposits, they don't have the cash when people come to withdraw it. Bank runs break out like wildfire. Crowds surge outside local branches, banging on locked doors and screaming for their savings. By the time the dust settles, 9,000 banks have collapsed, and 9 million savings accounts have been wiped out. The crash was the trigger, but it was the lack of regulation and the mountain of debt that turned a market correction into an economic apocalypse. The government initially made it worse by passing the Smoot-Hawley tariff, which choked global trade by 66% as other nations retaliated. By 1932, America is unrecognizable. Unemployment has hit 24.9%. Homelessness and breadlines are common sights, and shanty towns called Heskers, Hoovervilles have sprouted across the country. It would take the New Deal and World War II to finally incinerate the Depression as factories began running 24/7. The Great Depression stands as a grim warning that greed and poor oversight can lead to disaster. Today we must ask, do stock prices reflect true value, or are we just waiting for the next bubble to pop? Once you've seen the system collapse, you never look at a stock ticker the same way again.